But we begin with this market sell-off more broadly as the rebound attempt this week has failed. Let's bring in Unlimited CEO and CIO Bob Elliott and Richard Bernstein Advisors CEO Richard Bernstein. It's great to have you both here on what is another down day and down week for the major averages. Bob, I'm going to kick this off with you because one of the conversations we've been having is the idea that so-called smart money or hedge funds and institutional investors are really selling here, de-risking ahead of the tariff April 2nd deadline next week and coming into quarter end and basically sitting on dry powder. Is that what you're seeing in the data?
Yeah, that's certainly right that what you see is hedge fund managers are really pulling back. I think the thing that's interesting is they came into the last couple of weeks with low conviction, trying to get a feel as to what direction policy would go. And right now what we're seeing is we're starting to see a shift towards a more bearish sentiment, looking at de-risking their equity portfolios, buying bonds, and most importantly, they're as long gold as they've been in more than a decade. So apparently they've been listening to us talk on Friday afternoons. Yes,
and I'm going to get into that too because we did have another record high for gold. You've been bullish on it for quite a while. But first, Richard, I want to get your thoughts on the market here and the fact that we did breach some technical levels in the S&P as well as the NASDAQ this week, and certainly pretty weak trading session here with a number of factors, including inflation, including, tariff uncertainty, et cetera, factoring in here.
Right. Well, Morgan, it used to be that the word that we saw unprecedented use of was unprecedented. Now the word that we're seeing unprecedented use of is uncertainty. So I think, the market is very simply, I think everybody knows there's uncertainty. Right. And we could make a list of all the different sources of that uncertainty. And what's happening is a very normal process where the market is being revalued for a higher risk premium for U.S. assets. Right. The more what businesses need, what investors need is clarity and consistency. And we've been lacking both clarity and consistency. So when you don't have clarity and consistency, you want a higher risk premium. It's like a junk bond versus a treasury. You want a higher risk premium. And so that's what we're seeing. So we've seen about 4 or 5 multiple points knocked off the S&P so far this year, despite reasonably healthy earnings. And that's everybody reassessing for the uncertainty. Now, you couple that, just one more thing here, you couple that with the notion that we entered the year with investors being historically confident about the future. If you look at, Merrill Lynch showed that the private client beta was up to 1.7. Michael Hartnett at Merrill pointed that out. I mean, that's tremendous amount of risk in a portfolio. So what you did was you entered the year with people being incredibly historically confident, and they got socked in the jaw by all this uncertainty.
I mean, 3-month chart, if I look here at the NASDAQ, Bob, and we're down 12% here. For the S&P, similar situation, we're down 6%. We know it's actually much starker than that if we look back at, just a month and a half. Dow, similar situation. Meantime, Treasury yields have actually fallen. 10-year back below 4.3%. We've seen a rally in Treasuries. Do you like that better than stocks right now?
Yeah, I think when we're looking at what's being priced in right now, we still have just unwound the euphoria that Richard was just talking about post-election. Right, but what we haven't done is we haven't meaningfully priced in a slowing of growth that's likely to occur. If you just think about where are we in the S&P 500 right now, we're not that much lower than where we were prior to the election. At the same time, what we've seen is an administration that's delivering a set of policies that are pretty negative on growth, whether it's restricting immigration, the tariff policies, DOGE cuts, employment cuts, et cetera. All of that lines up with a much weaker growth picture ahead, and those pro-growth hopes have been dashed, and they're now meeting essentially a wrecking ball of policy that is going to slow growth ahead at a time when the Fed is now being handcuffed. And today's data was such a good example of how challenging it's going to be for the Fed to get ahead of this. When you have core PCE coming in at 0.4, when it continues to be up close to 3%, the Fed cannot move until there's a meaningful weakening of growth, and they haven't seen it yet in the data, and so they're not going to get ahead of this the way that they had hoped to before.